welcome. Thanks for joining us today. I would say we'll give people some more seconds, 1 or 2 minutes to arrive, and then we are ready to get it started. Nick, what I can already tell for those who are already here, we will for sure have a dedicated Q&A session in the end. So feel free to ask your questions in the dedicated question section. It's in the bottom right, where you can also vote for the most relevant questions. So feel free to answer them, and please don't put it in the chat, the questions, put it in the dedicated question section. Perfect. So let's wait 1 or 2 more minutes, and then let's kick it off. It's not only German people joining, therefore, I mean, if it's only German people, we would, of course, everyone would already be here since 4 minutes, I guess. But should be ready in a second.
I guess Enrico has Italian heritage, but also lives in Switzerland, so it cancels out in the end.
Yeah.
In Berlin.
Oh, true.
Sadly, not a Swiss tax resident.
Perfect. I think let's get it started. So super happy that a lot of people have joined for our roundtable webinar, where we of course will answer the secret of succeeding with your seed round. So first, some organizational things where the session is scheduled for 60 minutes. As already mentioned before, we will have a dedicated Q&A session in the end. So feel free to put all of your questions in the dedicated question section on the bottom right, and vote for the most relevant questions. And on top, we might have also some polls during the webinar, so also feel free to join them as well. Yeah. So quickly starting with myself, a quick introduction. I'm Christian. I'm co-leading DACH market at Roundtable. What we are doing, we are structuring investments in the private market at large, either offering VC funds as a service or by a deal-by-deal approach. With the second, we also help founders to run a clean, efficient fundraising by pooling their investors into SPVs. So their cap table stays super clean and easy to manage. And therefore, during my everyday job, I speak a lot to founders and investors all across Europe, and therefore I, of course, see a lot of things which go right or wrong at the seed stage, and of course this is something we want to tackle this section. And as said, and I guess that's why all of you joined today. This session is about how to succeed with your seed round, and I guess it's not only a usual one-on-one in fundraising. I'm super happy to have 2 outstanding, super interesting people with me today. So you will hear real tactics from an experienced founder who's currently building one of the most exciting companies in Europe, and you will hear behind-the-scene perspectives from Enrico, who's partner at one of the most one of the leading VCs in Europe at Lakestar. First, quickly, some words about Lukas and then about Enrico, and then, of course, guys, I'm finished with my monologue and give you some time to introduce yourself. So first, as said, Lukas He is CEO and co-founder of SE3 Labs. It's a spatial AI company, building technology that you can actually understand and analyze the 3D world around us. And it's super technical, but super interesting company. And before SE3, Lukas worked directly with Elon Musk, so he brings a very unique mix of frontal tech and hands-on startup building with him. And on the other side, we have Enrico from Lakestar, as said, one of the leading European VCs, where Enrico is partner, and he's led several outstanding investments, such as Arx Robotics, Fyxer, Ravical. So he has a very unique view on what top investors are looking for in seed rounds. Perfect. Quickly about the format. We now take some time to get both Enrico's and Lukas' view on the seed rounds, and then we will have moderate discussions for about 25 minutes, followed by a very quick lightning round, and then, as mentioned several times, we will have a dedicated Q&A session in the end. So starting now with the introduction, Lukas, starting with you, maybe can you take us back to your early days of SE3 Labs? What problems you were obsessed with, and how did you kind of translate them in your first funding conversations?
Yeah, thank you, Christian. Thanks very much. So when we founded SE3 Labs, basically one of the founding stories was that I got the option to stay with Tesla, but wanted to come back to Europe to build something here of my own, and also try to have a company that's as ambitious as Tesla, as the other Silicon Valley companies, and that we can really like keep up out of Europe. On the other hand, Simon, Daniel, me, we had really been working on writing software AI that understands the 3D space at the same level that ChatGPT understands your text, your PDFs for many years. And we saw that it was a very good time to turn it into a company and succeed. And when we raised the round, we had been going for a bit over 6 months, 10 months maybe. And what we had done initially is really look very systematically at potential markets where the things that we knew would be the next wave of technology could be used, and we could generate some revenue. And by then we had 2 markets, dual use, on the one hand smart infrastructure, and on the other hand defense, European defense. And we had seen already that defense was picking up way more quickly than the civilian use case. So we were really thinking, A, about how do we build very competitive companies in Europe, B, how do we build AI that really understands 3D space, and it's much further than what any other company is doing today, and then 3, how do we combine this to basically strengthen Europe also on the defense perspective. I was at the time, of course, in the fundraising process, and there's many things to say about it, and I'm super happy to answer any questions about it specifically. But then we actually ran a very structured fundraising process, worked a lot on the storyline, went out with the deck, had, of course, a lot of introductions, all the usual things. And then it was also a mixture of structure, but then also things just happening by opportunity, because Enrico I met at an event in London that I randomly attended. I think he as well. We didn't know each other before and hit it off super well. And then the process went actually very quickly. And actually, I remember the story about Roundtable as well. I was at another event in Madrid, which was a very nice summit about European defense. And I managed to call Evan, the founder of Roundtable, then, because someone gave me the intro, and he was like super helpful in setting up Roundtable, because we had 15 angels from the US, from all over Europe, from everywhere. And it really helped us simplify the process. And really in fundraising, there are sort of 2 stages. The first stage is until you have the term sheet or multiple term sheets and it's signed, and then sort of the legal process afterwards. And Roundtable is a huge help in the second part, which is actually a ginormous process in Germany or in Europe that you need to push through and get all the documents. So maybe to sum it all up, AI, European defense, and European sovereignty. And really happy about how Roundtable simplified our raising process. And maybe before I hand over to Enrico, I think one thing that's always a bit funny is, of course, in the founder community, there's this whole, oh man, like investors are so stupid, like whatever kind of thing going on. But I think it's actually highly mistaken. I think actually investors are a very good forcing function on the ecosystem, and specifically top investors really understand what the required things are to build like really venture scale companies. And I think it's actually very good because we do know many other German companies, they stay in the basement for 2 years, build something they think the market wants, then they come out, the market doesn't want it, and they basically go bankrupt like a year later. And then it's just 3 years of their lives, like without any super tangible outcome. So I really encourage everyone to understand how investors see a startup and what you need to do to basically fit into there. I think it's also perfectly fine to not do it, but then you just need to find a different funding strategy, say bootstrapped or something else. And with this, super happy to hand over to Enrico, who has been a great partner so far.
Perfect. Maybe one, sorry, before we hand over to Enrico, sorry, one quick follow-up question, Lukas, because I mean, from at least my point of view, your business model, your product itself is quite technical and also, I would say, pretty complex, at least from my point of view. And especially, I think that could be super interesting for technical founders here. How did you kind of simplify your story that also like super early investors and also such as business angels could get your product, your business model super quickly?
Yeah, super good question. Definitely one of the key things for technical founders. I think for us, it was important that very early we tried extremely hard to be sales-led and do revenue, because that is in the end like the ultimate language, right? I mean, of course, there's always, and of course, a pre-seed or seed stage. It's not like you have a ton of revenue, but it just shows that you have the ability to market the product you have correctly in the market that's required so that people are actually willing to pay you. So I think that is sort of the best way to do it, because in the end, no one can argue with this, and they can always go call your customer, and then the customer tells them, I need this for all of these amazing things. And yeah, then I think it's also just a lot of iteration. We had a good set of amazing people helping us with refining the pitch until it lands. And then the other thing I think is also just practice, right? If you, within the fundraising process, you do a lot of conversations with people, and you usually understand when they fall off, right? So if you have the conversation and you try like one way of pitching your idea and you see their eyes go like somewhere and they take out the phone, of course, it's not working. So you really need to find the way of presenting it where they stay engaged with you throughout the conversation.
Perfect. Great. Thanks, Lukas. And of course, now let's switch to the other side of the table for a moment. Enrico, from your seat kind of at Lakestar, when you look at the European seed market at the moment, what's your take on the kind of the biggest misconception of founders, what they're still having about their first initial round?
Yeah, so I think, I mean, we as a team, I think it starts at the top of the funnel, and I think we can take a macro view on what's going on. When I started in venture, and this was 9 years ago, I had worked in a startup before, and we did an IPO with Delivery Hero, and back then I thought, oh, this is normal, you work in a startup and then in the end you IPO. I think that's the plan, no? Back in the day, it looked a little bit different because everybody, was fueled by the Oliver Samba rocket internet machine that churned out startups in a very particular way. When I started in venture, we looked at something like maybe 800 to 1,000 companies a year, and that was kind of like the volume we had to deal with. And we looked at due diligence timelines of like 3 weeks, something like that, on relatively competitive deals, sometimes 2-3 months. I was at Project A at the time, and then things accelerated tremendously. Our team here at Lakestar last year, we reviewed something like 12,000 opportunities in a year. We've taken meetings with something like 2,500 roughly, and we've invested in 10. So I think what founders oftentimes misunderstand is what the other side looks like just from a volume perspective, right? As a fund, it's our job to find very robust ways to weed out the best teams, especially in early stage. You really bet on a team. In transparency, when I met Lukas, I did not really know how the market will evolve. I had no idea what is really required for him to sell to the right customers, etc. I saw somebody who's uniquely able and uniquely driven to do something that is very hard to do, but at the same time, possible for somebody of his skill set, right? So we match these things, and we try to get a glimpse of greatness even in the early phases that are where it's hard to judge. It's our job to weed through thousands of founders and say, okay, these are the opportunities where it actually makes sense. I think that founders, many founders don't understand how rigorous these processes can be, and how at the same time they're also still very firm specific, right? Certain firms like certain founders, they like certain profiles of companies, they like certain stages. Much of that is also a follow function of what the fund size is. Typically fund size dictates everything, which also in turn is interesting for anybody who's interested in SPV based investing, like Roundtable enables, because you can kind of circumvent some of these problems, but we can get to that later. So I think some of the misconceptions is, I don't know how to put that, but I think how rigorous and how steep the cutoff from seeing a company to investing in a company is, I think is still to many founders unclear.
Perfect. Thanks. Maybe one or two follow-up questions. So when you look at a company you might invest in, or you at least due diligence in it, what are kind of the 2 to 3 things you absolutely want to see or understand in the very first meeting? And on the other hand, what are the common reasons you don't invest, even though you thought you liked the idea?
Yeah. So let's start with one universal thing, because I think that is true for any form of early stage investment and even a late stage investment ultimately. But really in early stage, it's, in my view, pretty much 80% of the decision is on the team, right? You need to understand whether the team has what it takes, both from a founder to market fit perspective, as well as just general abilities. Have they demonstrated that they can perform under pressure, that they can deal with a lot of the uncertainty and the headwinds that you get in trying to build a company, and are they ambitious enough to keep going for 10 years or more? And that is, I think, that leads to the second question. So the rest of the equation is pretty much market and outcome, potential size of the outcome, right? I think there are markets that attract everybody, right? Like currently, AI is not even a market anymore, right? Essentially, it's just a technology. But the amount of AI sales enablement agent things we've seen it's mind-bogglingly large. And whilst I don't think that there won't be a winner in this market, it will require somebody very, very unique, I think, to make it out of that jungle. So oftentimes we look at how obvious is this market, and is there an unfair insight that the founder might have derived from his previous work or whatever they've done before to give them an edge here. That combined, and that is the last factor, the size of the outcome. The size of the outcome that you're interested in as an investor is dependent on your fund size, right? If you look at most of the funds that have invested in Lovable as an example that everybody's interested in, at Lakestar we put a scout check into Lovable in the round that Hummingbird did. We bowed out of the Series A because we saw no way that this can return our 260 million fund, and at the current valuation it's at, it also wouldn't have yet, right? So many of these companies need to become so mind-bogglingly large that I think a lot of founders look at it from the perspective of, well, I can see that this business is working, I have customers who are paying for my product, I can make this bigger. But really, can you turn it into a 75 billion behemoth like Revolut? I think this is an entirely different question, and I think that's what Lukas was referring to earlier. We've been investors in Spotify and Revolut and in some other companies that got really big. Can the business model achieve that is a somewhat esoteric question that obviously nobody knows, right? I think a lot of people told us, I mean, back then when we invested in Trade Republic at Project A, we had lots of discussions how big the market can be because Germans don't buy stocks, right? Like, a lot of it is, potato, to be honest. But the ability to, the opportunity that a business can even become that big based on the business model and the scalability around the market and the competition and the founder being relentless about that goal, those are those three factors that you can't look at in isolation. They have to all work together, and then the conviction comes to invest.
Perfect. Thanks, Enrico, and also Lukas. Before now, I think we've seen both sides of the table, and now, I mean, even though we have already been in kind of a discussion before, so let's move over to the discussion, and I'll kind of try to have it in a little bit structured way, so 4 to 5 roughly mini themes, so we're not jumping too much and stay on the other hand also a little bit dynamic. Let's kind of start with the groundwork of before the round, right? So before you set the first stack, what should be in place? So maybe towards Lukas, what did you actually prepare before your seed round, and how far in advance actually have you already started building relationships to investors or to potential investors, and also refining your storyline?
Yeah, very good question. So I think many people have different views, but on average, there's 2 ways to do fundraising. One would be the relationship method, where you really know investors for, say, 6 months plus, right? You know them well enough that you know whatever their kids' names or something. And then when it comes, they just love you so much that they basically give you money because they believe in you as a person. I think this is a method that sometimes might be not available to sort of first-time or younger founders, right? The classic would be that you have been a CEO of a startup before and you go with the same investors again. The other one is the momentum method, which is the classical method, which most people do, which is basically you go out, you raise a round, and you create enough momentum and talk to enough people that it works. In the second case, it is actually an extremely high-intensity process. And as Enrico said, I think what is super important is it's non-linear. So if you're at 99%, you fail. If you're at 101%, you win. And it's not like, I think this is especially crucial for founders like that have been good at school or university. It's not a thing that's easy. Like, many things in your life have been easy. I think many things in startups are actually hard. And the fundraising is one of them. So for us, we actually put many weeks of work before into it, right? Of course, the pitch deck is 10 slides. So you think, how long can you take for 10 slides? But really getting the storyline straight is probably a multi-week process where you want to talk to many people, see that they understand the story the way that you want them to understand, and so on. I think that's very important. Then all the other materials like your data room and everything should be ready, because once you enter into the actual fundraising process, you will be so busy that you can't do anything else, essentially. And the last thing is that it's still quite required that you do have a network. So you generally don't just send a pitch deck to an investor. I'm not even sure if they would ever open it. So you should always come through an introduction. And I think what Mark Andreessen is saying is this is sort of like it might sound like a stupid test, but it's actually a relevant test, because a lot of the sales you do, you also have to come through a connection, right? So if you cannot manage to get an introduction to a partner at a fund, it means that probably you won't get an introduction to some relevant decision maker at some other organization either. So you build up basically your network, so you get high value introductions, you build all the actual material, you build the storyline, and then you really go out. And then for me, it was a harsh process of many days. I had 10, 14, 20 investor meetings really back to back, which is it's hard to stay still super enthusiastic about your idea on the 16th call on that day. But I guess Enrico probably does 16 calls on the other end, and so it doesn't matter much. and then you just push through it. And another thing that also Enrico said is you should only talk to the right people. So I mean, like investors, it's an information arbitrage game, so they will always be willing to get information. So they'll essentially always meet you if you're like a high quality founder, generally speaking. But for example, if you talk to a, say, Series A onward fund for your seed, it's completely useless. So don't do it. Or if they can't invest in your vertical, it's also a waste of time. So also make sure you talk to the right people. But yeah, and the last thing that's actually super important is, I think if you have not done it before, you need to do it full time. So maybe there's some repeat founders, for them it's the 6th round, they know how to really handle it. But if it's the first time, you need to do it full time. You need to let all other responsibility go and just do the fundraising, and then your co-founders have to take care of the rest, and you just focus on the fundraising.
Perfect. And then maybe to Enrico now. We kind of touched this already slightly before, but when a founder shows up to the very first meeting with you, and I mean, since you are a partner, there might even have been a meeting before with whomever. But what kind of signs tell you that they have done their homework properly versus they're just trying their luck?
Okay, so first, I think first important bit is I try to do as many first meetings myself as possible, also as a partner. I'm not sure if I was partner when I met you, Lukas, or whether I was principal, but I think
you were just transitioning.
Yeah, I think so, but that has not changed. I think this job requires everyone, across the hierarchy to spend time with founders and also hunt the opportunities, because I think the ability to open doors for somebody who is junior in the chain versus a partner is also a different one, right? Like I can probably open the door to a different type of founder than an associate. So ultimately, I'm required to do the work, right? But nevertheless, you're right. Somebody else might have been in the meeting before, but generally, I try to be as early as possible in the process. And so, what do I look for? And to be fair, do I personally really care whether somebody has done the homework on Lakestar? Frankly, no, because I think that what I'm looking for is, do they understand what's up? Like, as in, do they know how this market works, right? Like, I think the one thing that Lukas mentioned is a great example where I see a bunch of founders on LinkedIn going like, yes, but I sent you our pitch deck to your info at whatever email, and you never even answered. Again, my previous point, we look at 12,000 companies a year. If you can't get a warm meeting, you're not good enough, period. And I like to say that in all its harshness, because it's exactly what Lukas said. If you know that a warm introduction performs better, it will help you in sales. It will help you in closing talent. It will help you in hiring people. I mean, if you're not willing to go through that effort to secure capital for your company, then maybe you're not serious enough about it. And we're trying to back people who are really trying to build a really big company, and that is incredibly hard, and the chances are low, and still they grind themselves through this process. And hence, yes, it is, it might seem like a stupid filter on the surface, but it also could seem as if you're making other people responsible for your inability to do the thing you're trying to do, right? So in my view, it's not so much that I look for the people having done the homework. Like, for example, honestly, like there are founders who, that's not like use the Lakestar example, because with Lakestar it actually happens quite a little, but with Project A, it often happens that founders had never heard about us. We were German at the time primarily, and we try to win deals also in other geographies. That's okay. I think what is less okay is when there's an absolute blind spot to what VCs need from you, what a process should look like, what the dynamics are that we also try to create, right? Like there's weird things around, people using fundraisers as in advisors or brokers to create these connections and do the fundraising meetings for them. Like all these things don't work, and you would really easily find out if you spoke to a few VCs. So it's all in the same vein of, if you really want to play this game in the Champions League, then you should probably do the homework to see what it looks like in the Champions League, I guess.
Perfect. Thank you. Before we come kind of to the next theme, still want to invite everyone to. We have already some questions, but feel free to ask and vote for them. We will answer them in a few minutes then. Perfect. And then, I mean, of course, after preparation, having the storyline, everything more or less set, there's kind of a very practical question from my point of view. How do you actually kind of structure your seed round and your cap table for the future? And I mean, Lukas, maybe to you already kind of mentioned you've raised both from angels and VCs. When you started raising, how did you actually think about the mix between a lead investor, even some strategic people, and angels on your cap table, or like was this structure kind of already set in your mind before, or how did you come up with this structure?
Yeah, I think it's a very good question. Of course, it applies only to my case. I would personally be very careful with strategic investors. So I don't know, like big companies from your space or something. I think this can often be a pain point for actual VC investor then, but Enrico probably like has a better idea there or better opinion. I mean, generally you want 1 or 2 lead investors. These are the ones you actually need to close, right? I mean, you can basically have infinite follow-on capital. If no one wants to lead the round, you don't have a round. So this should definitely be like the core focal point. And there, I think, of course, like brand value of the investor is a big thing, because basically as an early stage startup, you borrow some of the brand value of your lead investor. You also borrow some of their power, if that's relevant in your certain industry, right? So they might have the much better network. For some industries, that's very relevant. For some industries, it's not. But I think what it also really comes down to, for me personally, is very much a personal connection, because you are sitting on the board of your company with the partner for 10 years, for 20 years, could even be longer. I think there's examples where it's 30 years. And if you don't like them, and if you don't think they will support you through the highs and lows, then I think it's not a good relationship to have, because it is one of the most important relationships. And I think conviction is actually a very important thing there as well. So like conviction is actually a scarce good in a startup, because in some sense, like half the time you think we can only win because all the others are extremely stupid. And then half the time you think you can never win because the other companies are all already so big and you're like just coming up and growing up. So there's all these moments where you just need conviction from your founder, from your investor, and you don't need them to get cold feet. You need them to tell you, just go on and go hard, and you're going to win eventually. And then if we come to angel investors are essentially, at least initially, zero downside. So in some sense, like the worst angel investor you can have is one that just doesn't interact with you at all. It's not true. There's like some very specific cases of super unethical behavior, but on average, that is a true statement. And then it's just super amazing, because you can get all these great people who have built companies before, who have, in our case, been like very famous journalists, who have super deep insight into the market. And on the one hand, I think for many angel investors, it's actually a like personal thing to give back. I think also for me personally, like once the company becomes very large, there's no cooler thing than to help the next generation. So I think often it's just a very like a personal emotional connection. And then they might just have insight into the market that's amazing, or insight into building companies or something. So there, I think really, especially early on, when I mean, of course, it's super hard to get an angel in a Series B, because that never makes sense for an angel investor. Their early stage access is what makes it like economically good for them. So that is also a point where I think having something like a roundtable is very good, because then if you have 5 angels or 25 angels or 35 angels, doesn't matter. If you had 35 actual angels on a German cap table, that would be a nightmare. Like you could like probably from a process point not even get the round like closed quickly, because it's all horrible. So you need a strong lead investor. That's the main thing. And then I think it's good to build a broad and strong base of angel investors. In our case, we also had a co-lead investor seed camp that we super highly respect. We love the guys there. It was also a nice combination because they're from the UK, and then Lakestar is like pan Europe or even pan worldwide. So, but they're also investing everywhere. So both worldwide funds, but a bit different profile. So that was amazing. And then a lot of angels on top. And maybe one last very tactical thing is there are certain angel investors that are a very good signal to the market. So within your fundraising, you can basically build up, right? So when you come to a potential lead investor, you're like, these 2 unicorn founders already gave me money and I have like follow-on capital committed. So if you just do the lead, like everything comes into place. And that can, of course, be a very good signal that you understand how it works.
Perfect. Thanks for sharing, Lukas. And maybe to Enrico, then quite related on that one from your perspective. I mean, the answer is probably very clear, but does a healthy capital kind of look like for you? And maybe even more interesting, is there any example in your investor's career, so to say, where you didn't invest because the cap table was super messy, or you kind of forced the founders to change anything that you invest?
Yes. First of all, shout out to whoever Apolline is, because this is the way to get an intro. I'm happy to do this.
Nice.
Well done. So no, clean cap table. So yeah, there is a lot of people. So I think you can put this on a timeline and create a graph. So with increasing maturity of an ecosystem, the cap tables get better. In the beginning, especially the Berlin ecosystem, but everywhere in Europe, there was still this, there were still these sort of daytime robbery incubation investors who would be like, oh yeah, we give you 150K, and for that we only take 40% of your business. Like all this shit went on quite, for a long time, and it messed up a lot of great founders' cap tables. The sheer fact as to how many people exited companies in those years and actually walked away with comparatively very little is mind-boggling. You would be surprised. I think generally what has changed is that founders now understand what their worth is in early rounds, right? And there are dilution benchmarks, and so generally on dilution, I think the market has normalized somewhat. There's still the odd one out where I'm seeing, a very small convertible, converting into 30% ownership for some investor who was early enough. But I think this is reducing quite substantially. What I do see, and this is, I think, one of the great effects of you guys at Roundtable enabling this, it can become quite a mess if you have small angels and there's a convertible, and then there was somebody else with a top up, and then secondaries got moved around left and right, and then over time you have this incredibly messy cap table that doesn't really lend itself to easy governance, right? Because essentially why this is a problem is not because other people own some of the company. That is, they invested for that, that's the deal. But the problem is if you need a vote with everybody for everything, if you need a POA with everybody for everything, if you run to the notary with a group party of like 45 people, obviously everything becomes a little bit too much of a headache. So with SPVs, it's possible to structure that. And when I started in this job many years ago, the reality was setting up an SPV was possible, but it was very expensive, and like nobody wanted to go through the hassle of that. And then also, who's the sheriff in that SPV, and who decides for who's the in German it's koordinierender Gesellschaft. I don't know what it is in English, but so that has changed. So now there's actually very cost-effective mechanisms like Roundtable to pool all these angels into one. Whoever's the sponsor of the SPV can lead that. Even the founder can lead that, and this way you can manage a fragmented group of investors who can actually oftentimes help you much more than VCs can, because I'm some professional money spender who has done 9 years of spending other people's money, and even though we multiplied it successfully, ultimately I have not built a company myself. So angels are typically the ones that have done it, and they can be more helpful. And this balance of creating sleek governance, but also having all these people involved is, I think, a huge benefit for most founders and should be utilized more. There are many other reasons why SPVs are becoming more popular, and I think a lot of that is also in regards to a more active secondary market, etc. But I think for the people who are in this call, I think the most relevant bit is it really helps you structure a professional cap table where there's not 45 lines of people who own 0.0001% of the company.
Perfect. Thanks for sharing, and it's of course music in my roundtable ears. But like a little bit now moving to the actual fundraising process, and I mean, I've been there already also a lot of times when having my own startup, and therefore at least I don't know if how it was the case on your end, because you get a lot of no's. Also, you in the end succeed with raising the round. Maybe just one question there: what did you do, or how kind of did you motivate yourself and the team, even though there were maybe, I don't know if it was the case, a few no's in a row? What helped you to stay also kind of rational on that one?
Yeah, very good question. I think we were actually pretty lucky in the sense that the fundraising process was relatively short and the amount of no's was okay, and we were never like in super despair. I think the first part is I would actually not share it with the team. I think there's also a very good quote from the CEO of Labs. I think there's nothing that's or for me there's nothing as distracting as fundraising. It's also like constant emotional roller coaster, and I think if you communicate too much to your team, they will also just have the emotional roller coaster and not get any work done, right? So I think it should just be the effort of like one founder, usually the CEO, and maybe some people helping them, and then they should just go do it, and they come back with the money, and that's basically it. And then they tell the team that it's now done. How do you motivate yourself? I think this depends on everyone. Is different, right? For me, of course, it was just necessary. What can I do, right? So you just go and you go for it, and you go through with it. I don't know if you have a relationship or something, maybe that helps. It is very normal to get rejected. I think that is maybe the thing. And what also helps is, I think, especially very good VCs, they often have like their anti-portfolio, so companies they said no to, right? So you can go and be like, oh, all these people said no to Google, and now they say no to me, so it doesn't matter because Google was amazing. That can help a bit. And I think on the other hand, you just need to keep going. I think the thing that actually helped me a lot is that we very specifically structured it in a way where we had a relatively long window for fundraising. So that I think the worst thing in the world would be if you know the money is running out in like 5 weeks. So I need to fundraise in 2 and then also get the transfer to the bank account. This I would try to avoid, very harsh. Otherwise, just keep going and realize that the people on the other side are also just people. They don't have the like magic glass ball. They also just take a guess on a company, and maybe it's the wrong guess.
Perfect, thanks. And then maybe last one to Enrico, and then I saw there's a lot of questions being answered. Then we move over to the Q&A session. But maybe to Enrico, last question. I mean, in the end, I think Lukas mentioned it already. Sometimes it is, or some more often than sometimes, the relationship between a founder and investor is also something like a marriage. So you're kind of related for several years. So is there anything basically what tells you you want to work with that founder for a long period or not?
Yeah, I mean, you can see one person here that I'm happily married to, Lukas. You know, I think it is quite simple. I have this might not be the most economically rational decision, but after a few experiences in my career, I've now decided to never work with assholes. I can't get rich enough to spare myself to deal with the headache of dealing with somebody who really is an asshole. So what defines that? I think there's apart from the extreme cases of people, being dishonest or fraudulent even, right? Like, I think there are a few things that create mutual trust and respect. I think first of all is communication style, right? I think that, to some degree, I understand when people have their cards, close to their chest during the fundraising process, because obviously in that moment I'm still in competition with other funds to invest in the company. After the investment, in theory, we should be entirely incentive aligned. And then if founders are then playing their cards close to their chest, it can really taint the relationship quite a bit, because then you don't build trust and you always wonder if you're getting the whole image, etc. I think that this behavior can also, you can see telltale signs of that before the investment, right? Especially there are things that are just good proxies for that. So quick speed to answer. I mean, my team, we speak to 12,000 companies a year, and yet my answer velocity, I mean, Lukas, you can attest to that. I try to answer to people, especially founders that I work with, basically when I see the message. So I think that's a good indicator of mutual respect. I think that there is the ability to obviously not, display some panic if things go wrong, but like the ability to find the right balance of sugarcoating and just telling it how it is. I think you don't need to come to your investor with every single thing that goes wrong, because for that, too many things go wrong in a startup. So, that doesn't make sense. But I think waiting to tell somebody said this to me recently, and it really made sense. Bad news needs to travel fast. Like, if something really bad happens, you call immediately, and then we can figure it out together. If you wait until the last moment, then sometimes I'm also, lost for optionality, and I can't help. All these things, if I can see them in the behavior of the founder early on, I get the trust to want to be working with them for a long time. Apart from obviously the shiny things that are, a founder is super smart, he's super driven, super ambitious, super inspirational, like all these things that are obviously very visible and obvious to the outside. But I think more on a level of, sometimes this trope or the meme has become that VCs are useless people who just spend other people's money, and they're the gatekeepers of capital that just sit around in Mykonos all summer. This job can be also quite hard and quite tough, and I'm putting my personal money, because I do invest in the funds also. I'm putting a considerable amount of my personal hard-earned money plus my reputational risk on the line for founders also. So I think having this, eye level kind of respect between each other and understanding how hard it can be on both sides is a prerequisite for me to have a good relationship with somebody that I work with, period, by the way. Also, like people in the same team or, in a partnership, etc.
Perfect. Thanks for sharing that, Enrico. And then looking at the time, let's jump to the questions from the audience. Let's if possible, let's answer them rather quickly, so we can cover at least the majority of them. And maybe the first one probably directly for Enrico. If you were fundraising, what's the most unconventional move you would make? Something 99% of founders don't do. Quite nice question here.
If you were fundraising, what's the most unconventional move you'd make? Something 99% of founders. Interesting. So I mean, the thing with the unconventional moves is that you really can't come up with them on the spot. But I'll try and give some examples. So something that can really make sense is going the extra mile to create a personal meeting. There's, and we're sitting in one, I realize, but it's not the same to do a Zoom call and build up personal relationship as to, actually meet in person. So sometimes going out of your way as a founder and go where the money is, in fact, can really help. I mean, some founders that I know have European founders have just booked tickets to San Francisco, and they were like, I'm going to Sand Hill Road and I'm going to figure out how to get a meeting. And they actually ended up succeeding, right? They took the risk and they figured it out with cold emails. One particular founder that I know really well from Berlin, I'm not going to name him because I don't know if he wants this story out, but what he did was he booked a ticket to San Francisco and he cold emailed. He was in a very boring market that nobody found interesting. He cold emailed Sam Altman and said, Sam, this is my history and my story. And like, he wrote a really good cold email that converted. And Sam Altman just answered, yeah, okay, I'm in the office, come up, you have 5 minutes. They talked, he convinced Sam put an angel check in. And then the guy said, can you now introduce me to your 3 best VC buddies? And he got the intro, he got a term sheet from everybody. Then everybody got wind of it. 17 term sheets rained down on him, and he's now the hottest shit in Europe, pretty much. And what that was is like a lot of balls. Obviously, you have to sit on a plane. Like it takes time. It's expensive. Like there's all this risk of failing and looking like an idiot. But ultimately, he succeeded. And then, understanding what social signal means. Now and at the time also, Sam Altman was about the hottest signal you could get. If he invests in your cap table, then a lot of people want in, right? So you can play this.
Perfect. Thanks. Then maybe the next one from Teresa. A question from an early stage startup. What revenue level is relevant for VCs? 50K, 500K ARR? I know, maybe also to Lukas. And of course, you don't need to share your revenues back then. But I guess assuming you were below 500K back then, right?
We're not sharing any of this publicly, but I think no matter the exact level, it's mostly proof for what you do, right? No one's going to look at that revenue and be like, oh man, the discounted cash flow and this, like, we're going to make so much money over the next years. But it does show that you do something right. And then Enrico has a much better opinion.
So I'll give the easier answer to this is nuanced, obviously, right? It's not that it does not matter at all, but I tend towards it doesn't matter at all, especially at seed stage. It's also not that, there's a benchmark. There's absolutely no benchmark. But frankly, like, we know what it takes to build the thing that you're building, right? Like, there's an idea as to how much effort it is to ship this product. If you're doing some AI wrapper and it's really easy to build, and essentially you could build it in 2 weeks and get going, then if you don't have revenue half a year in, I'm wondering why. If you're building, a quantum computer, then I think it's okay if in the first half year you don't have revenues. I think that's also fine. So like, it's a little bit, it's a little bit a question of what it is you're doing and where you are in the timeline of having done it.
Perfect. Thanks for that. And then next one would be Appeline's question. I think if you add Enrico on LinkedIn, he will for sure remember your name because
my LinkedIn is an absolute trash can of a lot of spam that I'm receiving from agencies who want to help me reach my B2B customers better for some reason, but I will fish out that name, Apolline.
Perfect. And then next one, maybe again to both. What makes a great warm introduction? So what helped you, Lukas, in your fundraising?
I think very good question. I think it's also what Enrico said now. It's basically understanding how the social signal works. I think, right, the best is probably like the hottest guy in your area. So it's often maybe an ex-founder that's like currently the biggest superstar. And then he goes to his investor that he knows for 15 years. And he's like, that guy's like me 15 years ago, but double better, right? I mean, this is probably the hottest thing you can get. There's also actually negative intros. I want to mention this. Sometimes investors, because they don't want to just tell you no, they're like, it doesn't really fit us, but I can intro you to some other people. Never, ever, ever in the world take this. There's only if that investor for some reason really can't invest in your type of business, but it has to be like, they do climate investing and you do something completely different. But generally, like the first question on the phone will be, why are you not putting your money? And then also what was in Enrico's story before, it is, of course, a money-driven business. So if the person who's giving the intro has skin in the game, it's a huge, huge, huge advantage. And even the other way around, if they are people who say write angel checks and they don't have don't do one in you, right? The first question will be like, you're passing that guy to me, but you're not investing, so he can't be like that great. I would say that is the warm intro. So it should be someone who's super well regarded and who also understands like why this should be an amazing company, and who should be ideally close to the person that he's introing you in. And maybe last point on this, it's maybe not a popular thing to say, but it is in some sense a very hierarchical market. So an intro from a partner is about infinitely more valuable than an intro from an analyst at some fund, right? So be a bit careful with trying to build a network. Like you basically need a network at the highest level.
Perfect. Thanks. I guess this was answered perfectly. And Enrico, if you have anything to add, feel free. Other than that, we move on with the next question.
I think the wisdom here is simple. You don't take clothing recommendations from a blind person.
True.
True.
And then let's move on with that one. Then we see if we can cover one more. Probably to Enrico, what's the top soft skills you want to see when founders are fundraising, and what are they useful for?
Soft skill, yeah. I mean, in soft skills, there are many. I think, emotional intelligence itself is not a soft skill. I think there is the ability to put yourself in the other person's shoes informs whether you can be a great leader, marketer, fundraiser, essentially everything, because I think any good sales process relies on understanding what the other person wants and not what you want to sell to them. There are great public speakers who literally run against walls in sales conversations or in fundraising conversations, because ultimately you need to understand what the other person wants and not what you want. You need to match two things and not just present your thing in the strongest possible way. And I think that is essentially emotional intelligence or empathy or whatever you want to call it. But I would probably boil it down to that, because also that will help you hire the best people. It will convince people to follow you into what is probably the dumbest decision ever, which is to join a really early stage startup that has very few proof points. Just from a statistical perspective, it's all terrible. From an asset class perspective, all terrible. But yet again, obviously, we all strive for that stroke of luck and that potential for the outcome and the ambition and what we can build together if it all goes right, and the impact it can have on the world. So I think if you have the ability to make people want that and make really unreasonable decisions, I think that can really go far.
Perfect. Anything to add from your end, Lukas?
I perfectly agree. Maybe on the asset class, I think on the hiring side, I don't agree at all, because even if the startup doesn't work, I think the things you learn are way more valuable than what you would have, say, learned at BMW or some other sort of old school type company. The people I know that have worked at failed-ish startups are now all at Facebook, Google, Tesla, you name it. Generally, I think the talent density is super, super high in the correct early stage startups. So even if the startup fails, I think you actually do better as an early career person to be in a high ambitious startup, because you learn so much more. So I think as a career move, it's actually a pretty good move. On the rest, I agree.
Perfect. Thank you very much. Unfortunately, there's still some questions left, but we're now running out of time. So to everyone whose questions we didn't answer so far, feel free to reach out to me afterwards, and I will make sure we will answer the questions afterwards. And yeah, as said, we're at time, so
there's a lot of crying smileys. I have 5 more minutes if we want to go fast. I don't know about Enrico. Okay, we're out already.
You muted it.
Sorry, I could do 5 more, of course.
Okay, let's do 2 or 3 more questions. Okay, maybe then starting with this one question for Lukas. What are the indicators that drove the decision that it's exactly the right moment to raise? I mean, besides probably the bank account, right?
No, bank account was fine. I think we saw the traction and we really knew how we could convert the raised funds into more growth, which should always be the answer. Never tell a VC you're out of money.
Yeah.
Also, don't be out of money. They smell fear. It's like the printer.
Agreed.
True that. Perfect. Dan, I mean, is there what's the smartest business model you've ever seen for an AI product replacing a function? I mean, that's a pretty tough one. But does one business model come to your mind when thinking through this question?
So I think with Fyxer and with Lovable, I guess we're still standing to see how smart that business model really will be, right? I mean, we did the investment in Fyxer not long ago. They're growing very fast. They're adding more than 1 million in ARR per week. But in AI, it's very dynamic. With Lovable, I mean, there's obvious reasons to love it, and there's obvious questions also how durable it is. I think that the most interesting bit is if you can at least capture one part of the value chain. And I think that in many B2B markets, there is the hope that you can capture data pools that aren't available to the large language models and that they aren't easily accessible through large platforms such as Salesforce, etc. If you are in industries that are somewhat captive of data, but also niche and long tail enough to not, be entirely obvious, then that's interesting. If you're working with anything that is entirely obvious, then things get a little bit thin. So yeah, generally I think those guys are fast growing and they're in that regard, they're very smart business models. I think the test of time is ultimately the thing that will show how smart it actually was.
Perfect. Thank you. And then let's go for 1 or 2 more. That one here, I find it very difficult to get into revenue stage without building the entire platform. Do you think I need to change the approach or make anything to start getting revenue for scaling? Always chicken egg problem, but
well, no, maybe because I don't know who's asking this. Can you raise all the money in one go to build the platform? If not, then you should probably change your approach.
Simple answer, I guess. And then really the last one for today. Let's take this one. What's something not many people think about that has made you decide not to fund a startup? So any random reason you did not invest?
A random reason. I mean, there's been in all my career, I've had one legal hiccup where after term sheet and during the long form, we discovered there was some IP issue and then the whole thing exploded. But that was not random. That was just a bad coincidence. And to be honest, it wasn't also the founder's mistake. It was just a major fuck up. I think something that I react quite allergic to is how the behavior changes once money hits the account. And this is something that you can read, especially when you invest in seed or Series A, because there's at least one round of capital that went into the company. And you can always tell when you go to the office. Nobody needs an Apple Studio display. There's a few things you just don't need. You can just buy the cheaper thing. So there might be reasons, but if a few of them compile, I get a little bit worried as to what the goal here really is. Also, I think founder salaries should be high enough to create some comfort, because also you want to be focused on the company. In 2020 and 2021, there's been some excessive practices around that.
Perfect. Things both of you. And I think now we're already on time, so we'll have to wrap it up here. So thanks for the great questions to the audience. And of course, Lukas, Enrico, thanks for sharing everything, for being so open and concrete about everything which the audience or me asked. And to all others, we will send both a follow-up email with the recording and also a quick summary of it. And feel free, if you're preparing the seed round, pre-seed round, whatever, and you want to have a clean cap table, reach out to me at any time, because that's what we do at Roundtable. And yeah, thanks everyone for joining. Have a great day, and of course, good luck with your potential fundraise.
Thank you very much, Christian. Thank you very much, everyone, for joining in, and have a great day.
Thank you guys for having us, and see you soon.
Thank you. Bye-bye.
Bye-bye.